Hey everyone, welcome to the KE Report and a daily editorial on this Friday, April 4th. It is a sea of red in the markets. We're seeing the major averages down close to 5%, and we're seeing essentially red on the screen across the board. The only markets that I'm seeing up today, the US dollar, volatility, and bonds. Clearly, it is a scary day for investors out there, and it follows a pretty down day yesterday, too, all after Liberation Day, which I think these markets, they're showing us that they're not very comfortable with what's going on around the world. And hey, probably a number of reasons for that. We are chatting right now with Marc Chandler. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. Now, Marc, just a quick little recap here of the markets too. The S&P just this month is down 8%. We're only on the fourth day of this month. The Nasdaq and IWM, the small caps, those are down 9 and 10% respectively. Again, just this month. It's a sea of red out there, but we always talk to you about currency markets. Those are the largest markets out there. Money flows in and out of these different countries, I think is very important to really take note of where money is going. What are you seeing right now in the currency markets there, Marc?
Yeah, what a volatile week. It's been momentous as far as magnitude of moves. And I think you're right. The first couple of days of the week, it was quiet. We were just waiting for the tariff announcement. We get that. And I think this is what confused the market is that several U.S. senior officials, like Treasury Secretary Besson, said during his confirmation hearings that the dollar would likely rise on the back of tariff increase. And this was, I think, the general consensus, especially the Trump administration. And instead, stunning, the dollar sold off very hard, net on the tariff announcement. And so what you ended up happening is that, yeah, the dollar fell sharply. And it's sort of that way you were talking about with the stock market, sort of like a cycle, right? People are focusing on the in growth implications of the tariff, not so much the inflation implications. By focusing on the growth, money leaving the stock market, some of it left the country. And we see that because the dollar index fell about 1.25%. But some of that money, of course, is driving down interest rates. And as U.S. interest rates fell, the Japanese yen strengthened after that relationship. And the yen, just ahead of the weekend, the dollar yen fell to new lows since the middle of October last year. It's really this, like these reverberations from the tariffs and people trying to game it, whether it is a tactic or whether it is some kind of principled drive to get business back, like reshoring, and to boost revenues so they can pay for these tax cuts they want to make permanent.
Well, Mark, the thing that really stands out to me is that almost in every sector, you're seeing exaggerations in the volatility. And when you look at volatility, to Corey's point, the VIX, it's up 34% just today. It's up at a 40 level. We haven't seen that in a while. So you can see that people are hedging. They're using options to try to hedge the downside risk. When you see this kind of volatility in currencies, in equities, and we're seeing it in commodities across the board, how do you handle that, and how do you encourage people to blaze a path forward? Should they be buying right now? Should they be sitting on the sideline? Should they be moving to cash? Is that why people are moving to bonds? What do you see as the pattern out there?
Yeah, and I think that's a good point. If we look at a chart of like the S&Ps or the Nasdaq, we've gapped sharply lower uh, Thursday and Friday, and we're settling very weak relative to the day's range as well. So that sets us up for a possibility of a gap lower opening again come Monday. But I'm beginning to think that this move, there are different ways to think about how far that rubber band can stretch. How much of a move can you have before you have a natural like the snapback where people who are looking for to buy say this is a good enough level, and people to sell have like sticker shock and hold back, even if it might mean steeper losses. And so I think that if we were to gap lower in the stock market come Monday, I'd want to see how we behave, but I'd begin looking for a buying opportunity. But it's got to really do that. It's got to really gap lower. It's got to be like uh, this kind of like cathartic sell-off where people just give up, where they throw in the towel, sort of a capitulation. And I think another gap lower opening and this high degree of uncertainty, which might not go like we might not be able to get that genie back in the bottle. And so I think that uncertainty has scared a lot of people, forcing them to the sidelines.
Well, also, what the algorithms are they now just in a sell mode rather than a buy the dip mode? I think that's a big question that we don't actually know the answer to. But boy, oh boy, by today's sea of red, it kind of seems like that. Mark, don't we need to be a little bit more worried that this could turn into a longer term bear market here where maybe the buy the dip mentality doesn't work and it's not just for a month or two, it could be for a year or two?
Yeah, I mean, it could be right. I tell you the truth, I don't know what I'm eating for dinner tonight, let alone where the stock market is going to be like in 3 months from now. But I do think that, that's why I find that even though I tend to be, spend my days thinking about macroeconomic fundamental factors, I really need to incorporate that technical analysis into like the overall view because that's a way to like measure, to quantify your risk. And like when you're just wrong, if you say, well, it has a macro to things like they have an X% tariff or something, or China is going to put a tariff on us. And how do you know when you're wrong about the price action? And so I think that these gaps, and it sounds very old school, but there's a whole theory about gaps in the market. And I take a look at those theories if you can, and you can put that in your search engine, and you can find just gap theory, technical analysis, and these gaps that we have now in the S&P. I think it gives us a way to measure, to quantify the kind of risk by trying to pick a bottom, thinking that these gaps are going to be attempted to be filled. And so we want to just watch how this possible third gap on Monday plays out. So ideally, what we'd have it was a gap lower, and then people like myself would come in and buy it and close that opening gap. It would settle near the highs of the day. And then other bottom pickers would come in and see if we could fill up the next gap. But that's, I think, the general direction. I think that the fundamental news, too, these tariffs that were announced, these reciprocal tariffs, at least in the short run, I say, can it really get much worse? And I say that because after those reciprocal tariffs and ahead of the weekend, China announced retaliatory tariffs of about 34% on all U.S. imports. They banned a few products and they're going to tighten up their restrictions on some rare earths. So, like another shot has been fired in this trade war and could still escalate. But I'm thinking that broadly in the markets, the bulk of the bad news is known already, and we priced that in on Thursday.
Yeah, Mark, it's a good point on the charts as far as gaps typically getting filled. The issue arises where there's multiple gaps down, where it's a gap followed by a gap followed by a gap. Which one gets filled? And so, and also sometimes there's breakaway gaps where they never get filled for a long period of time because it's a trend in motion that continues. So we'll just have to see what happens technically. But the point you bring up as far as some of the different market volatility and people's expectation for the trade wars and the shots being fired by multiple countries in this kind of an environment, let's bring the Fed and central banks into the equation. Do you think that there's going to be a call for an emergency rate cut? Because I'm seeing press releases about that and editorials about that hitting the markets. Do you think that in this kind of an environment where inflation came in a little lower, but the markets are seeing a lot of volatility and jobs are also being lost, will the Fed act and will other central banks act?
Yeah, I think so. Maybe the first thing I say is, I fully agree with you on like one gap, two gaps, but three gaps in a row becomes another type of pattern. But it's just worth taking a look at it and seeing how it plays out. But yeah, I mean, Powell was very clear, and when he spoke on Friday, and he spoke a few hours after a relatively strong U.S. jobs report. Well over 200,000 jobs being created, the vast majority of them in the public sector, though despite all this talk about government job layoffs, the government sector, that could include state and local governments, added workers. So Powell says, basically, he just reiterated what he's previously told us. The economy still, he says, in a good place. Most of the economic weakness is coming in from soft economic data like surveys, not the real sector data or hard data that comes weekly jobless claims. Very little change. Like I mentioned, strong employment report. Still looks like we had very strong auto sales as people tried to beat the tariffs. So Powell basically says we can be patient. And I think that barring another, say, a shock, I think that we'll have the Federal Reserve on hold in May while the ECB and possibly even the Bank of Canada will have to be cutting rates this month. And what kind of shock could get the Federal Reserve to cut rates? Well, like you're mentioning, we look at like the Nasdaq down 12% this week. The S&P is down almost 10% just this week. And so if you were to tell me that next week is a repeat of this week, then I'd say that the deterioration of financial conditions and the tightening of them has gotten to be a point where other central banks may have to act, or the administration might have to figure out another policy.
This is what I find so interesting is that it seems like everyone's almost in a way turning against Trump in the sense that they don't want to play into that game. They don't want to start cutting to react to what he's doing. And it's around the world. And if they do react, it almost feels like they want to push back rather than playing into maybe what he was expecting central banks or other governments to do. It's just a big question mark. And we are broadly seeing, I think, the world fight with the US. I can't get away from that conversation living in Canada here. Just how many people are saying how disappointed they are with what's going on in the US and how angry they are. That brings up a whole other topic that some people have outlined on our show here recently that maybe we're seeing a generational change here where instead of looking favorably at US markets or the US broadly, countries and individuals are saying, I'm done with it. I'm going to move my money or focus elsewhere in other countries. Today is a tough day to really make that argument because literally everything's down. Even European markets are down 5, 6, 7%, and the dollar's bouncing back. So it really brings up that question, are we seeing broadly an outflow of capital from the US, something that is more sustainable and who knows, maybe decade or two long? Mark, what do you have to say to this whole theory?
Yeah, I don't know. I'm a bit skeptical too. Partly I'm skeptical because I'm old enough to remember other times when people had these same ideas. I mean, Nixon breaks the gold standard. August 1971, and the dollar, despite the end of Bretton Woods, despite the way the U.S. did it, U.S. dollar still remained top dog country for what has it been, another 45 years, 50 years? And so I think about the Suez Crisis, 1956, where the U.S. forces Britain and France to a retreat from the invasion of Egypt. I think about the Vietnam War, which wasn't popular. I think of some of the other wars the U.S. had, like the weapons of mass destruction in Iraq. And so I think that we go through these things and the size. So think about what, not retail money like ourselves or maybe some of our friends or maybe even small businesses, but think about the large pools of capital. How do they, remember, a lot of them promise not the absolute returns like hedge funds. They're really promising us relative performance. Stock market's down. We're not going to lose as much money as the stock market for you. And of course, on the equity side, we probably underperform on the upside, but we protect you a little bit on the downside. So the theory goes. And so the size of the US market alone requires global investors, which is really a key to the diversification as it's like intellectually grown at the academies. Diversification requires owning global diversification, and it also requires then owning a big stake in the United States. And I don't think we get away from that or the size or the role of the U.S. Treasury market. I don't think that we have so badly hurt ourselves that that world asset managers rip up everything that's been their Bible, if you will, for so long.
Yeah, most people resist change, and there may be change underfoot, but I don't think that people are just going to wholesale avoid the U.S., but there could be some capital flows out of the U.S. Let's also bring the commodities into the mix here, Mark. It's been a wild week there. It's interesting that gold is still above 3,000, but it's dropped $200 really in the last couple days. Silver fell out of bed. It was up over 35. Now it's at 29. Copper made an all-time high just 2 weeks ago, up in the mid fives. Now it's in the mid fours. It's lost almost $1. And oil dropping down below $62, $61.70 at the time of this recording. Commodities also taking it in the shorts. What do you make of it?
Yeah, so different stories there, but I'd say to me an interesting one that feeds into this rally in U.S. Treasuries that is lower yields is a big drop in oil prices. Like you mentioned, I mean, we're looking at May crude having lost more than 10%. And I think that part of that story is going to be driven, of course, by the OPEC, which basically agreed to basically triple the amount of oil that they're going to boost its sales starting in May. And I think that the other part of the commodity story is partly that people believe that, I should say people, but a lot of economists believe that the tariffs are ultimately a brake on growth. They will slow growth. And so I think this changes things a bit. I think the gold story is interesting because I think that, we're told on one hand that it's the central bankers diversifying away from dollars, buying gold. And there's all these charts that show things like that are happening, right? Especially in the aggregate. On the other hand, a lot of retail people buying it too. And I think that what we saw happen this week is that those people that might have used gold as part of margin for buying stocks, or that they had gold were bought just because on a trend basis, the momentum traders, the trend followers. And so I think just what happens is people take their profits there in a big way with treating it then just as another risk asset.
That makes sense, especially the margin comments there. Gold is still doing very well, right? But some of these other metals too that have just completely fallen out of bed, and looking at the underlying equities too that didn't confirm a lot of these moves higher, I find it all just very interesting. But really the biggest takeaway here is that it's a sea of red. We're seeing gaps down everywhere. And look, I'm sure some of our listeners will go search up gap theory just to see how it could all play out, but Mark, when in history can we look back and say, this time, who knows if it is the same, but it sure looks similar?
Yeah, it's almost like every 100 years, we in the United States do this. 1820s, 1920s, and here we are in the 2020s. And it's almost like the memory, the institutional memory has to be lost before we try this again. I was saying to you guys off mic that I was looking at this New York Times front page the day that Smoot-Hawley was passed, and there's a little blurb on the left-hand side, left-hand column that was quoting Smoot, saying he thought that tariffs would be good for the stock market. And then here we are.
Yeah, here we are. It sure doesn't look good for the stock market right now. We'll see where it ends up. Again, this can all change in the time of one press conference or even one tweet if Trump does back off of a lot of these tariffs. And I think that would do a lot for people's, I guess, sentiment. But fact of the matter is, it doesn't seem like that's happening. And now it's a sea of red that we're all living through right now. It's a good time to be in cash. And other than that, I don't know where the safest play is. So you can try to pick bottoms, but boy, oh boy, if you tried to pick that bottom yesterday, you are getting absolutely run over today. Mark, great chatting with you. Again, Marc Chandler, managing partner at Bannockburn Global Forex and editor of the Mark II Market website. Click that link in the show notes to visit that Mark II Market website where Mark outlines pretty much on a daily basis key data points, economic news, and market moves. Thanks for your time today, Mark. I hope you have a great weekend.
Thanks. Good luck to everybody.